Good morning. We are live here on yourmortgageyourway.ca, Talk Radio AM 640. I'm Ryan Bonner, but I'm not alone. We got a full house today.
Yes, we do.
Roy Cocciollo, how you doing? Principal broker and owner at yourmortgageyourway.ca. And you're not alone.
No, we
Who
got
have you brought with us.
We got Jamie Johnston, broker and owner of Remax Condos Plus downtown. Let us know about what's going on in the real estate market. And my colleague Joe Basillo, also mortgage agent with Your Mortgage Your Way. He loves the hard stuff, so he's here to help us out. For sure to answer some questions.
So what right now? No. So what's going on? The Office of the Superintendent of Financial Institutions is making some changes to mortgage lending guidelines. Why are they doing that?
I think there's been some concern that we've been in a very long for low interest rate environment, and Bank of Canada has increased rates very modestly, but the last couple of quarters there's been inching up of interest rates. And the federal government and OSFI have been a little concerned for a while that consumers have started to borrow quite large amounts of money. I think you've probably heard in the news the average Canadian is now 167, 168% debt-to-income ratio underwater. And there's a real concern that as those interest rates start to increase, people are going to find that their debt is unaffordable and potentially put themselves in a precarious position around their housing. So a year ago, some changes were actually introduced that made it more difficult to qualify for an insured mortgage, predominantly affected first-time buyers, but essentially said even though the market rate for a 5-year fix at the time was probably somewhere around 2.6, 2.7%, you had to qualify at the Bank of Canada's posted benchmark rate, and at the time that was 4.64. So that the intent of that was to say, if you were a first-time buyer and you knew that you had a smaller down payment, you had to show mathematically that you could afford a mortgage that was more expensive than the mortgage you actually had. And the hope was it would ensure that people would carry enough room within their own monthly budget to weather that kind of a storm. Fast forward a year, now we're starting to see some of these increases. OSFI regulates the rest of the national market, really, and outside of just the insured mortgages, they're also looking to implement an equivalent type of a stress test so that anybody who's purchasing a house or refinancing a house is going to have to show that they can afford a mortgage that is more expensive than the mortgage is actually issued for, again, the sake of having that buffer within their monthly budget.
So, Paul, are these changes going to have a positive effect on, will these actually help?
We're a little bit concerned about some areas of the country experiencing a bit of an economic downturn. I think what we're essentially doing with this math is telling consumers that they have to buy less. Because when you do the math, when more of your monthly payment goes towards the interest cost than the principal cost, you're forced to borrow less money and therefore buy a smaller property, basically. That's going to have potentially downward pricing pressures on the market, because if you're trying to sell your home and there are just fewer consumers out there that can afford to pay for your home the value that it's currently listed at, that will start to sort of weigh heavily and potentially start to pull prices down a little bit. In Toronto and in Vancouver, we have so much economic activity and we have such an inflow of people, because this is where most of the employment is. I don't think you'll see too huge of an issue there, but in the Atlantic provinces and probably through the prairies where the economies are already not doing super well, if home prices start to fall a little bit, people tend to just stop spending money. They start to save because that's the largest asset. It starts to play to consumer confidence. And when folks stop spending money, you actually create a little bit of a recessionary environment in those regions, because local businesses just don't get to experience the same level of customer.
So, Roy, basically, it's Toronto and Vancouver. It's basically influencing this change.
So, I guess, Paul, who would this affect most now with these new rules coming out? And actually, let's go back to 1 second here. Can you give us a Coles Note version of what OSFI is looking to propose in these new the new B21 rules?
Absolutely. We are still in the consultation phase, so it's especially very important that I say this. I have every expectation that new rules will be brought into place along the lines of what I'm about to describe. But we are technically at the very end of the consultation, and OSFI is asking the marketplace for opinions on these things. So there may be a slight variation from what I described from what's actually introduced. But the proposal is that a 200 basis point, or basically a 2% stress test be applied to whatever the contract rate of your mortgage is when calculating eligibility. So if today's market rate for a 5-year fixed is, let's say, 3.1, 3.2%, when calculating the math to determine whether you're eligible, then you'd have to pretend the mortgage rate was 5.1 or 5.2. Now, there's already, as you guys will know, calculations that would make sure that you are not exceeding sort of a maximum gross debt servicing ratio and total debt servicing ratio. And these have already been in place. So with all of your other bills, you already are underwriting a mortgage to make sure that people don't spend more than 40% of their sort of gross income on their housing. Now that 40% is going to have to be calculated at the higher interest rate of the loan than the actual loan. So it really does create a bit of a reduction in purchasing power. Now, there are a couple of other things within these changes.
Well, Paul, I'm going to put you on hold there for a moment rudely. We just had to hit a quick break. Yeah, sorry about that. You can throw $20 or so into a slot machine while we take a break here as he's joining us live from Vegas. Paul Taylor, CEO of Mortgage Professionals Canada. Joe Basillo is also here. He's a mortgage agent at yourmortgageyourway.ca. Jamie Johnson with Remax Condo Plus, and Roy Cocciollo, principal broker and owner, yourmortgageyourway.ca. Any questions here, give us a call, 416-870-6400, star 640 on Sal. Back in a moment. And we're talking here about the Office of the Superintendent of Financial Institutions. They're bringing in, discussing, I guess we're still in the consultation phase, Paul, of bringing in new rules, stress tests for mortgages. And you were just telling us before the break that one of the things they're looking at is introducing an additional 2% stress test for mortgages, correct? And then I rudely cut you off, so I'll let you continue.
No worries. That's a great summation. That 2% stress test is really sort of the big news about the changes that are coming forward. There are a couple of other provisions that talk about pro-lending or co-lending activities and a little bit of sensitivity around sort of volatility in house prices in some of the higher appreciation regions, but those are much more sort of lender technical pieces. Most consumers are going to feel the impact of that 2% stress test first and foremost.
And this is whether or not you put 20% down or not. Is it 20% down or more? You'll have to take the stress test as well, right, Paul?
That's right. It really is. It doesn't matter what size of down payment you're bringing. If you're a third or fourth home purchaser and you have 70% of the value of the home to provide as part of that down payment, even for a very modest mortgage, you're still going to have to qualify as though the interest rate was 2% higher than the actual contract will be issued to you.
Now we've known that they've put some changes already out in earlier this year, and we've already seen it take effect in the marketplace. Do you really think that this stress test is necessary?
We're not proponents of it at Mortgage Professionals Canada, at least not to the same size. When the first-time home buyer sort of insured stress test was introduced, you do a little bit of back-of-the-napkin calculations, and it equates to about a 20% reduction in an individual's purchasing power, all things being equal. In some of the excited marketplaces, it's made it almost impossible for those folks to get on the first rung of the ladder. And in other places where property markets are less excited, Atlantic, sort of prairie provinces, people that used to be able to afford $160,000 worth of home can really now only afford $125,000, $130,000 worth of home, even though their finances haven't changed. Now, those numbers might seem a little ridiculous if you're in Toronto. Those are pretty standard house market prices, though, in lots of regions. And that can equate to a pretty significant reduction in standard of living for some folks. And it's got nothing necessarily to do with their incomes. It's just the sort of requirements now around the stringency of borrowing. Now, if we put the same equivalent type of a stress test, it's not exactly the same, but it's a similar idea, into the marketplace for all people to qualify against, it is going to have some impact on purchasing power for all Canadians. And that will start to have some downward pressure on house prices. In some markets, I know there's a lot of conversation about homes being unaffordable, and that might in some ways be a good thing. But I think we need to be really careful and strike the balance here between protecting the value of what is the largest asset for most people and the thing that they're probably banking most of their retirement on, and assisting people getting in.
So the suggestion is they might be rushing into this a little too quickly here.
You know what? They've taken, to be fair to them, a very metered approach to setting canvas in the industry. But I think the stress test is probably a little too stringent at 200 basis points. But as of the association, we've been recommending 75 basis points, which is basically 0.75%. If you recall, a few minutes ago, I said mortgage qualification is already incredibly stringent in Canada, and there are mathematics to make sure that you're not spending more than a certain percentage of your gross income anyway to service your debt. So all we're doing is making it more stringent now and allowing you to service that debt with less of your monthly income. Applying a 2% stress test on top of the already stringent underwriting is a little constrictive. If we were at 0.75% instead, and we harmonize the same thing on the insured side of the market, we think it would strike a much better balance between the market pricing and, potentially protecting consumers against those rising interest rates.
Now, do you think there's a large impact on the housing market in general? Do you think that this might be a self-fulfilling prophecy of the bubble bursting here in Canada, in Toronto and Vancouver especially?
There's a lot in that question. I don't think there's a bubble in Canada. I think that housing affordability actually has been very, very good, even as those prices have escalated, because we've been in such a low interest rate environment. It's much easier to service debt when your interest rate is low. And I think you'll find, actually, Parliamentary Budget Office themselves released a report in June that said Canadians have been managing their money in almost exactly the same way through all sorts of interest rate environments. And basically, 14% of their income goes to service that debt. Now, a 167% debt-to-income ratio at a 2% interest rate is a very different proposition than a 167% debt-to-income ratio in a 10 or 11% interest rate environment. That would just be absolutely unaffordable. But Canadians are quite prudent, and I'm sure that Roy and Joe on the line will say they've probably already been getting calls from their own consumers asking, is now the right time to lock in my mortgage? We've had a couple of interest rate increases, and Canadians are acutely aware of that stuff, and they're really prudent about the way that they manage their debt. And they're probably already taking measures to ensure that they continue to manage that. So I think Canadians as a whole are just very, very prudent. We're overreaching a little bit by trying to protect them from themselves with these changes, and should probably pull them back.
And Joe, as you pointed out earlier in the show, Joe Basillo, mortgage agent at yourmortgageyourway.ca. If you're just trying to run this directly through the banks, they kind of have rates that they're pushing. They're basically told to push these rates, and they're not going to give you all the other options that a broker might.
That's right. If they have that one product, and they themselves may know that there's some faults with that, and they're not going to disclose that to you. So it does have a lot to do with the timing as well. And most definitely, you have to shop it around. Once you found when we talk about, a lot of times people say, well, if I shop it around and I get all these different credit hits, what does that do to my credit score? Is that going to have a negative effect? You don't have to. As Roy said, it's really important that you talk to somebody, get a feel for how a comfort zone. Is this guy pushing me? Is it a hard sell? Does he really want my business, or is it in my best interest to deal with somebody else? Once you have that comfort level, that relationship, then by all means go ahead and have him or her walk you through the whole process.
Well, you can have Joe do that, or Roy. Both from yourmortgageyourway.ca. Jamie Johnson from Remax Condo Plus. Thanks for coming in as well. And it doesn't cost you anything to go to yourmortgageyourway.ca and start the process there, Roy, right?
Absolutely. Come down and see us, or if you want, give us 10 minutes of your time. Just give us a call. We'll talk to you for 10 minutes and try to walk you through the process, make you understand what you need to get prepared for, documentation-wise, credit-wise, all that kind of stuff, especially when you have parents gifting you money.
Yeah.
And anything like that. One of the biggest hurdles for, believe it or not, a mortgage is confirmation of your down payment.
Well, there you go. More to talk about next time around with Roy Cocciollo. We'll talk to you then. News is on its way next. Talk Radio AM 640.